So I think when you start for a discussion of life insurance, you start with really term insurance. And term insurance is really designed for a short period of time. Could be 5 years, 10 years, 20 years. Um, and the objective is while you need it. It's like renting a car. The shorter the time period, the less expensive the cost. And the good for cash flow, locks in your insurability. And the other type of product really is what I would call a permanent product. And a permanent product, you're building a cash value, the earnings grow tax deferred, and you have the ability to withdraw and or borrow against the cash value without paying tax on gain. Now, what are some possible reasons for permanent insurance? Again, you want coverage for a long period of time, maybe for estate planning purposes. You have an estate, there might be a tax due with the death on the estate, and some people use life insurance as a vehicle for pennies in the dollar to find the cash flow to pay the tax. Could be a supplemental retirement plan because the earnings grow tax deferred and you have the ability to withdraw and borrow without paying tax on gain. Congress limits the amount of money you can put into the product. As a result, some people overfund the product as a vehicle to be able to take income out later on a tax-free basis. And by the way, if you have a question, just hit the chat box, raise your hand, and I'll answer your question. Permanent insurance can be a great vehicle for college savings. In a business setting, lots of companies use insurance vehicles as a methodology to put dollars aside for key executives later with what we call golden handcuffs. So life insurance can have a lot of unique features. Now, the first type of permanent insurance we would call whole life. And whole life is kind of a fixed premium. So think if someone is 40 years old to age 100 or 60 years, or if they're 60, it's 40 years to 100. In a whole life product, the carrier determines the level mortality cost from age of issue to age 100, and that's how you determine the premium. So in theory, you're overfunding mortality risk in the early years, and thus you build a cash value, earnings grow tax deferred, and again, you can withdraw and borrow without paying tax on gain. So the question that surfaces a lot for people is, which is preferable, which is better, which is more ideal? Should I buy term, invest the difference, or use a whole life permanent product? And that's always been a question mark. So as the market has evolved, insurance companies start to design different types of products to take advantage of market opportunities. So the first generation was called what we call a universal life chassis, which is called a flexible premium, and it's adjustable life insurance. In theory, you can reset your premium each year as low as you want to a minimum, or as high as you want up to the government maximum because of the tax arbitrage. Where whole life is a fixed premium, universal is flexible. That product came out in 1982 when interest rates were paying about 12%, money market funds, not like today. So the first generation was a money market type product. Then as interest rates started to come down dramatically, mutual funds became very prevalent, and that brought the creation of variable life. Now, variable life is a permanent product, but you take the cash value and you park it in different types of mutual fund type investments. So the insurance company is transferring the risk tolerance from the insurance company to the consumer, and you can really vary your risk tolerance. You can be conservative, aggressive. You can move money around in different funds without paying taxation on the change, whether it's the same fund house, different fund house. So it's an array of funds to pick from, and the carrier lets you build your own risk tolerance. Variable life was an enormous product for about 20 years. And then we started seeing some corrections in the market in 2008, 2012. Insurance companies began to run focus group meetings, and they were seeing that people were saying, like an oxymoron, I want to invest in the equity market with guarantees. And that became the creation of what we would call index universal life, which is a product in which you park your money in the S&P 500 or an equivalent indices, and the carrier says, we'll guarantee you a floor, meaning if you pay $1,000 a month, as an example, every 12 months following a deposit, the insurance company looks at the actual S&P performance. If it's in negative, you get your floor guarantee. If it's in positive, you get what the S&P earned to a cap of either 8, 9, or 10%, depending upon the product and the carrier. So effectively, you can play in the S&P with a floor guarantee. So that's kind of just like a general sense of products. And what determines which is the right product? I think need, philosophy, length of time you're looking for coverage, cash flow, risk tolerance. Is flexibility of funding important? But ask the question, why do a lot of affluent people carry life insurance? It's a great asset class. Provides a guaranteed benefit, meaning if death occurs, there's certainty, there's a benefit paid. The internal rate of return on the premium to the death benefit makes it a rather attractive investment at death. It could be a supercharged Roth position, meaning you pay tax on income now, the funds grow tax deferred, and you can access the funds tax-free in the future. No government limits on how much you can put in based upon limits of life insurance. It's a great alternative for what I would say to be high income earners because of tax arbitrage. The investments, which we talked about earlier a little bit, whole life is like bond-like returns. You're using the general account of the insurance company. They take the risk, they pay a dividend. Again, a bond-like return, but it's being managed by top managers because insurance companies are really investment managers. The index universal life or variable universal life or equity-based products designed for the consumer who wants some risk tolerance, things they can outperform the bond market. Oh, and a couple of questions came up. So someone said in term insurance, well, what level period should I have? Because carriers offer a level 10 to, depending on age, up to level 40. The longer the level period, the higher the risk for the insurance company, and thus the higher the cost for the consumer. And in a level period, it's a level rate for that period of time. End of the level period, the carrier raised the rate to what's called a guarantee maximum, which is astronomical. So the insurance company level term is really pricing mortality risk during the level period. Because at the end of the level period, almost no consumer retains the coverage. Also in term insurance, you have the ability in most companies to be able to convert the term to some type of permanent in that same company without medical underwriting at your attained age. So what's the benefit? Change in health you can protect against. Another area that's really important, we've seen a lot with clients, and probably one of the most important reasons to review your current coverage is life insurance ownership and beneficiaries. Life insurance is income tax-free, paid to a named beneficiary, but it's in the estate of the decedent. So if you've got $1 million of life insurance and you die and you name a spouse or children as beneficiary, they get the money income tax-free. But the life insurance proceeds are in your estate at death. So depending upon the size of your estate would determine if the insurance creates an estate tax situation for you. And on estate taxes, the tax can be as high as 50%. So many people who have assets change the ownership of the life insurance out of their estate, either to children, a life insurance trust. Also, by moving the insurance out of your estate, you may be free from the risk of creditors if there's ever a lawsuit. In a business setting, the ownership could be the partnership, could be a partner, depending upon how many partners there are. Life insurance is a permissible investment inside of most pension plans if the pension plan has a provision to allow life insurance. What's the benefit of buying insurance out of a pension? You're paying pre-tax dollars. So effectively, let's assume that you're funding $30,000 a year in your retirement plan. And you want to buy life insurance. If you buy personally, you're paying after-tax premiums. So a $10,000 premium for life insurance might cost you $17,000 of earnings paid tax by life insurance. If you purchase the insurance inside of a pension plan, then you're paying with pre-tax dollars. Now, there are some regulations governing the use of life insurance in qualified plans, so this might not be the time to go through in total detail. I'll give you a couple of examples. If you've got a profit sharing plan, the government says that by definition, life insurance must be incidental to the plan, and they define that. And if you're using a whole life policy, it has to be less than 50% of your pension contribution. If it's a flexible premium product like universal life, variable life, or index life, it's got to be less than 25%. And there are some other regulations. So what I would say, if you have a pension plan, if you have life insurance or are considering life insurance, it would be a good conversation to have the pros and cons of considering where to buy it. Should a pension be the owner? Life insurance trust we talked about briefly. That's an irrevocable transaction done for estate planning purposes. It removes the insurance from the estate of the decedent at death. So it's income tax-free and estate tax-free. There are some rules governing ILETs. And again, you want to talk to a qualified trust and estate attorney. If you have existing life insurance and you're transferring ownership to a trust, then the government says you have to live for 3 years after the date of transfer for the insurance to be out of your estate. They call that the 3-year rule. If the ILET or a life insurance trust is the applicant for the insurance, day one, there's no 3-year rule. So again, ILETs are a place to consider and should be considered depending upon the size of your estate. How about beneficiary designations? Wow. Picture a family with children that are minors. And here's the typical designation that we see. A couple married, 2 young children. I name my spouse as primary beneficiary, and I name my children as contingent. Now, what does that mean? Husband and wife go out for dinner, there's a catastrophe, they die. The children are minors or contingent beneficiary. But based on state law, the insurance company can't pay the benefit to the children because they're minors. So the insurance company meets its obligation, pays the benefit to the court, they walk away. The judge now appoints a guardian and trustee from the court, and they pay a fee to govern those assets for the benefit of the children till the majority. And that majority, which is based by state law, they distribute the appropriate share to the child. Now, let's assume state law is 18. I don't know if every decedent parent would want every child to get the money at age 18. So in every state that I'm aware of, there will call unified gift to minor provisions, where you can name, instead of the children of the insured will equally, you create a trust in your will for the benefit of your children based on the state law that you live in or move to. And thus you've now eliminated this issue with the court taking over in a catastrophe. And you can kind of govern in advance how monies would be withheld, distributed for the benefit of children if they were minors getting the benefit. And that can be changed anytime you want, as long as you're alive and mentally fit. So a lot of issues, and I'll give you another example. I've seen designations where it says, I named children of the insured all equally as my contingent. Well, let's assume the insured dies, who's a male, happily married, and another woman claims that you fathered a child of mine and is successful in court. Because the designation said children of the insured all equally, any child of that insured will share in that benefit. To eliminate that risk, you say children of the insured by spouse all equally, but it's only the children of you and your then spouse. So again, I would urge you to look at ownership and beneficiary designations. A question came up just now about life insurance inside of a qualified plan. Can anybody purchase it? So let me just give you two examples. Profit sharing plans, which are called defined contribution versus defined benefit. In a profit sharing plan, if life insurance is a permissible investment in the plan, it's just a plan document provision or an amendment to a plan document, then anybody in the plan can purchase life insurance. If you have a defined benefit pension, ERISA has different provisions for life insurance. Defined benefit, everybody in the plan has to get life insurance. So sometimes you might have a pension plan where you want to put in insurance and it doesn't make sense because of the rules governing ERISA as provisions of life insurance. Good reason to talk to us or other people to get more intel on that topic. Let's touch your water, please. I think the biggest part of life insurance is you want to always try to make sure that the benefit is paid income and estate tax free. Because it would be a tragedy we lose half the insurance and the estate tax. And the laws governing estate taxes right now are changing under the current regulations. The exemption for each U.S. citizen is about 13.5. So a couple is almost $27 million. But that law sunsets 1/1/26, goes back to $5 million indexed for inflation. So tell me who'll be in Congress in 2026, and I'll tell you the tax laws governing estate planning. But having said that, it's easy to keep insurance out of the estate if you choose to. So tonight was just going to really give you just a general sense of life insurance. There were a few questions. We answered them. Our firm runs seminars every month, and notices go out in advance. Tonight I did the seminar. Each month we have a different speaker, different topic. So we hope tonight you found a value, and I want to wish you a wonderful evening.